Hi, I'm Gene Goldman. I'm Chief Investment Officer for Cetera Financial. I'm here to discuss tariffs and the market reaction. So, overall, the sell-off that we've had, we're not surprised by the sell-off. We're surprised the sell-off took so long to actually come to fruition. If you think about coming into 2025, we had 2 straight years of over 20% gains in the S&P 500. That's the first time since 1998. This led to extreme optimism in the markets and very high valuations. Then we had the coldest January since 1988 and a longer than normal flu season. You take these two together, this really pressured the economy, especially in weather sensitive economic sectors like construction and like leisure. So you take this together, what we had is that we expected a market correction. A correction is where stocks fall from top to bottom by 10% or more. But something happened. Liberation Day happened. And Liberation Day was when tariffs were announced on April 2nd that were much more aggressive than even the most extreme trade scenarios. You have the potential of higher prices, which could hurt demand. And this creates a situation called stagflation. And stagflation is when the economic growth goes flat or goes down and inflation increases dramatically. So you have the potential of stagflation or even a recession. The sharp sell-off is a sign, and it's clear that the stock market clearly likes economic trade and the trading between countries. So with that said, our agenda today is that we'll do two things. Number one, I'll cover the tariffs and talk about the market reaction. And number two, while it's hard to see how we get through this tariff uncertainty anytime soon, I do remain optimistic that stock prices will be higher by year end than they are right now. Most importantly, though, throughout my presentation, I'm going to keep politics out of this. This is a very politically charged discussion in terms of tariffs or no tariffs. My job here at Cetera Financial is to provide you just the facts. What is the potential impact on the economy and the financial markets? To start off, if we go to the next slide, the trigger for the market sell-off has been tariffs. As I mentioned before, they were announced on April 2nd, and they were much more aggressive than even the most extreme scenarios that were played out. You see here, for example, the result was a tariff average rate at a level not seen in over 114 years. And let's put that in perspective. The current tariff rate, if all the tariffs are enacted, would be higher than the Smoot-Hawley 1930 Tariff Act. And that Tariff Act back in 1930 was aimed to protect American farmers and businesses by raising import duties on a wide range of goods. By historians, it's widely regarded as a significant factor in worsening the Great Depression because it led to retaliatory tariffs from other countries, severely impacting international trade and the overall US economy. So let's turn to today. The scenario today is that you could see import prices rise as companies pass on tariffs to their customers. These higher prices destroys demand, and the result is that stagflation, which I talked about before, or worse, a recession. We haven't really seen the impact of tariffs yet on economic data, especially hard data. What we are seeing impact on is in soft data. Soft data usually comes from surveys. They're pretty timely, but they can be pretty volatile. Hard data, on the other hand, reflects measurable, tangible economic output. So let me show you on the next slide the soft data. And so one soft data that we watch carefully is the ISM survey of purchasing managers. First and foremost, it's the first look at the prior month's economy. So in this case, it's the first look at March's economy. And what happens in this survey is that ISM, the Institute of Supply Management, surveys hundreds of purchasing managers all across the country. And they're asked lots of qualitative questions. How's business? How's competition? How's hiring? How's firing? And they take these questions and they compile it into an index. If the index is above 50, it's considered expansionary. Below 50, it's considered contractionary. You see here, one of the underlying components is called prices paid. This prices paid component is surging in anticipation of tariffs. Again, this index does not show the input of tariffs yet, but it's surging in anticipation of these tariffs. We will eventually see prices rise, not yet reflected in the hard data. We probably won't see them until May or so, but we're already seeing price pressures rise. And if we go to the next slide, we're also seeing pressures in terms of economic data. So if you see here, for example, higher prices creates demand destruction because higher prices makes it more difficult to buy other goods. And you're seeing this in another component called the new orders component of the ISM, and it's falling pretty fast, pretty quickly. Another thing to think about too is that Sudden tariffs create a supply chain disruption. This is because there's less times for firms to adjust in terms of uncertainty around supply chains. So tariffs, you can expect greater near-term supply disruption. For example, foreign companies with heavy US exposure could curtail production, reducing supplies, and then US firms with complex globally integrated supply chains may not want to operate in a high tariff environment, and they may pause until supply chains are adjusted. You take the combination of higher prices, reduced new orders, and supply chain issues, you take that all together, it's a big overhang on our economy. And in general, there's a quick rule of thumb. Tariff-related hits on economic growth, or GDP, is usually about 10% of the overall tariffs. So let's just say, for example, if tariffs average about 22.5%, 10% of that would be about 2% in terms of GDP. So therefore tariffs could add about 1 to 2% to inflation, but could cost economic growth by about 1 to 2%. That's the stagflation story, slow economic growth and higher inflation. And you add on top of this stock market decline. In the last few days, we've seen the stock market lose about $7 trillion of equity wealth. And foreign investors who right now today own about 20% of US stocks. That's a record level and double compared to where it was back in 1990. This puts overall economic pressure on US investors, on foreign investors, and of course, overall economic growth. So if we go to the next slide, markets like trade, and we talked about this before. They like economic trade between countries. And clearly the threat of tariffs led to market reaction that was not that great. Tariff risks have been mostly priced into stocks, but the recession risk has not. Keep this in mind. When we have a correction is when stocks fall, as I mentioned, from top to bottom by 10% or more. That's usually a sign that the markets are expecting a potential recession. A bear market is when stocks fall from top to bottom by 20% or more. That usually occurs when we actually get a recession. Think about this. We've only had 3 bear markets without a recession: 1962, 1987, and 2022. Markets right now are getting close to pricing in an actual recession, as you see here on this chart. So if we go to the next slide, let's kind of pivot away in terms of what's happened to what's next. And overall, there is hope for negotiations. Unfortunately, though, here's the bad news. Tariffs are pretty sticky. They usually rise pretty quickly, but they tend to fall pretty slowly. Also, President Trump appears more tolerable to economic and market weakness than just a few weeks ago. Also, the sheer number of countries that are facing higher tariffs suggests that speedy negotiations are off the table, and non-tariff barriers, like, for example, European value-added taxes, are likely going to be more significant than tariffs. It's really, in my opinion, hard to see how we get through this anytime soon. But with that said, though, I remain optimistic that by year end, stock prices are going to be higher than they are relative to where they are right now. So let's talk about why. Why do we think stock prices will be higher by year end than they are now? So if we go to the next slide, the first reason is simply this: valuations. Valuations are more attractive. So in my role as chief investment officer, I look at valuations and to say, are stocks cheap or are they expensive? One common valuation measure is what's called the price earnings ratio. It's the price of the stock market divided by earnings. Higher price earnings ratio, or PE ratio, stocks are more expensive. Lower, stocks are cheaper. And if you see on this chart on the far right-hand side, valuations have come down pretty fast, pretty quickly. That's the good news. The first good news is that stocks are not as expensive as they were just a couple weeks ago. Great, great, great news. If we go to the next slide, another positive is the Fed, and there's a greater chance that the Fed could cut interest rates. I know there's some uncertainty. Just recently, Jay Powell, the head of the Fed, spoke, and he spoke about inflation and tariffs and uncertainty. And let me start with the bad news. Basically, Jay Powell said that the effects of tariffs are likely going to be larger than expected, and that he's worried about inflation still. Basically, if you read between the lines in Jay Powell's most recent comments, he said that if the economy slows down, we'll let it slow down. So what all that means, that basically means, and this is the bad news, that basically means is that the Fed will stay on hold for as long as possible, though they may cut aggressively if the economy goes into recession and consequently inflation starts to fall. That's a very important point, because you see here, this chart is very complicated. I apologize, but basically What this chart shows you, it shows you what the markets expect the Fed funds rate to be at year end. As a reminder, the Fed funds rate is the Fed's primary interest rate tool. That if the economy is going too fast and there's too much inflation, they raise it, borrowing costs go higher, and in theory, this slows down demand. Or on the other hand, if the economy is slowing down too fast, people start losing their jobs, the Fed lowers the Fed funds rate. This, in theory, makes borrowing cheaper, cheaper to buy that car, cheaper to buy that mortgage, cheaper to use a credit card. And this, in theory, stimulates the economy. The point here, what this chart shows, and that ziggy-zaggy green line is showing what the markets expect the Fed funds rate to be at the end of this year. Reading all this together, the market is basically saying we expect you, the Fed, to cut rates between 4 and 5 times by year end. And really, that's the positive good news, that there's a greater chance because of the economic slowdown from tariffs that the Fed could cut rates more than was really anticipated before. If we go to the next slide, one thing to think about is that overall, given the market sell-off, we've also seen bond yields come down. And that's good news because lower bond yields usually equates to lower borrowing costs. For example, you see here, this is the 10-year Treasury yield. The 10-year Treasury yield has come down quite dramatically. And why is that important? Because mortgage rates, for example, are usually linked to 10-year Treasury yield. So the good news, if you're looking for sort of this optimism within this cloud, is that yields are coming down, which could reduce borrowing costs. If you go to this next slide, another positive is that the economy is still pretty solid at this point. Yes, there will be some impact due to tariffs. Yes, this could put recessionary pressures on our economy, but the economy is coming off of a very strong point. Think about this. The unemployment rate, a measure of the labor market's strength and weakness. Again, the higher unemployment rate suggests more people are out of a job. Lower unemployment rate suggests more people are working. Right now, we have an unemployment rate of 4.2%. That's a pretty low number. And you add in the fact that weekly jobless claims, initial filings for jobless claims, are about 220,000. So a low unemployment rate, low weekly jobless claims suggests that the labor market is pretty solid right now. And you just look at the most recent payroll report. See the red circle here? It was pretty solid. This suggests that the economy still has some firepower. So long story, yes, the economy will be impacted by higher tariffs, but the good news is that the economy is coming off of a pretty solid base with some pretty strong firepower. If you look at this next slide, another positive is basically what the revenues are used for from tariffs. So you think about tariffs. Tariffs could be a large source of revenue. And we estimate it could be between 500 billion to 750 billion. That's a pretty large amount of money. And the good news is that we could potentially avoid a recession if tariff revenues are quickly recycled back into the economy via some type of tax cuts. I know there are rumors out there that the government, the administration may use tariff revenues to pay down a budget deficit. That's not a good idea, in my opinion, because basically what you're doing is you're doing fiscal tightening. You're tightening your belts while at the same time the economy is slowing down. That's not a good combination. I do suspect, given recently how we've heard that the Senate Republicans have initiated a budget plan just recently posted. I know there are more details coming, but if you see some of the early details, it's pretty pro-growth in its details, including a potential extension of President Trump's 2017 tax cuts. Long story short, if tariffs are kept where they are right now, the tariff revenues could be recycled back into the economy to mitigate some of the economic loss. If you look at this next slide, another reason to be positive is just market sentiment. So, market sentiment is usually a contrarian indicator. If everyone is bullish, if everyone wants to buy stocks, is usually seen as a bad indicator that eventually people will start to sell stocks. On the other hand, if everyone's really bearish, as this chart shows you here, as a contrarian indicator, it tends to suggest that maybe stocks could bounce back. And see the red circle here? Basically, this contrarian indicator, we have usually at this level in terms of bearishness, we've seen stocks bounce back historically. Again, another positive sign why we think stocks could be higher by year end relative to where they are right now. And then if you go to this other slide, This is something we've talked about all year, is that there's a ton of cash on the sideline. You see here the combination of money market assets and savings. It's about $27 trillion. It's a lot of money on the sideline that could flow in the stock market looking for better valuations. And remember, we got better valuations. We came from a price earnings ratio of about 22 and a half all the way down to about 18. Stocks are much more attractively priced. Again, a lot of cash on the sidelines. That's really good news. So then if you look at this slide here, this next slide, I think it kind of takes everything and pulls everything together. Whether or not the sell-off continues, our opinion is that it's primarily a binary event. It's either going to be stocks are going to do well if tariffs come off or get reduced, or stocks will continue to struggle if tariffs continue to stay on. It's a very much of a binary risk focus on tariff risk. But with all that said, though, if you look at this chart, this chart puts in perspective the stock market and volatility, because we are seeing a lot of volatility in the stock market. If you look at this chart shows in the last 45 years, the S&P 500 has been up 37 out of the last 45 years. And just to look at this more carefully, you see this chart, see those green bars? Green bars are the S&P 500, the annual return. If the bar goes higher, it's positive. If it goes down, it's negative. So again, 37 of the last 45 years, the stock market has been positive. Stock market has a positive bias because the economy is growing, earnings are growing, and we are a growing country. On the other hand, see those little blue rectangles? Those are each year's worst decline, their drawdown, their pullback, whatever you want to call it, their sell-off. And what if you take the entire average of the last 45 years, the average intra-year loss is negative 14.4%. So stock market has a historically long-term positive bias, but volatility is a normal part of investing. To take advantage of this, you've got to be invested for the long term. And how do you do this? Number one, be diversified. Have exposure to different parts of the market. Don't just focus on one company, one segment, one sector. Be diversified. Have exposure to different parts of the market. Second of all, make sure that your portfolios are in line with your long-term objective. Don't be too aggressive. Don't be too conservative. How do you know if your portfolios are too aggressive or too conservative? Reach out to your financial advisor. Let them review your portfolio. Let them review your financial situation, because you don't want to be too aggressive, nor do you want to be too conservative. So listen, we are in interesting times. We have uncertainty around valuations, around tariffs, around the markets, around recession. And if you go to this next slide, there's so much uncertainty going on right now. But the good news is that we do believe that stocks will be higher by year end compared to where they are right now, because of quite a few reasons around valuations, around the Fed, around tariff revenues. Again, lots of positives out there. But the key thing you need to be focused on, be diversified and invest for the long term. With that, I really want to thank you. If you want to follow us on X or Twitter, formerly known as Twitter, please follow my team here at Cetera IM, or of course you can follow me. That'd be great. Thank you so much. Have a great day, and we'll talk to you very soon. Thank you.